What does cash-free, debt-free actually mean? How does it work in practice? And should you make use of this mechanism in your next M&A deal? I'm Malcolm Zoppi, an English qualified solicitor, and in this video we will discuss the cash-free, debt-free mechanism in M&As. Alongside giving you an example of a cash-free, debt-free deal and how that mechanism works in practice, we will discuss the concept of adjusting a purchase price according to completion accounts. Fantastic, let's get started. So why is the cash-free, debt-free mechanism used in M&A deals? Well, usually only a percentage of the purchase price is actually paid on completion. The rest is typically deferred over a period of time. And when I say deferred, I mean payable after the business has already been bought. Purchase price adjustments typically in practice are made by increasing or decreasing the deferred payments that the buyer owes to the seller. So how this works is typically completion accounts are produced, and completion accounts, as you may know, are financial accounts of the target company representing the financial position of the company as of completion. So on completion, what were the company's financials? So that's what the completion accounts do. According to the results of the completion account, the total purchase price is either increased or decreased, and that increase or decrease typically takes effect by increasing or decreasing the deferred payments. Now, there are three main ways to adjust the purchase price in an M&A deal: on the locked box basis, on the cash-free, debt-free basis, and on the net asset value basis. In this video, we will focus on the cash-free, debt-free basis. But if you want to find out more about the other two kinds, make sure to watch this video right here. Fantastic. Now, before we move on to actually going in depth about the cash-free, debt-free basis and how that works in practice, make sure to send me an email if looking for professional legal advice. With our legal advice calls, there are no charges, no obligations, and no nonsense. Contact me now at info@zoppi.co.uk. That's info@zoppi.co.uk. Fantastic. Moving on to cash-free, debt-free. What does it mean and how does it work in practice? Cash-free, debt-free simply means that the seller is supposed to hand over the business to the buyer free of any liabilities, debt, and free of any excess cash. Now, as discussed, the cash-free, debt-free basis is a mechanism. It's a way to adjust the purchase price. So, for example, if the seller were to give to the buyer the business that still had liabilities, then those liabilities are going to adjust the purchase price by decreasing it, typically pound per pound. The opposite is true when it comes to excess cash. So if there is more cash in the company's bank account than expected, then that excess cash is going to increase the purchase price, typically pound per pound. Fantastic. Now let's give a concrete example of how this would work in practice. Let's say that we've got a purchase price of £1 million, of which 600k is payable on completion and 400k is deferred over a period of years. Completion occurs, and shortly after, a few weeks later, the accountants get together and produce the completion accounts that reflect what the target company was like as of completion. The completion accounts reveal that as of completion, the target company owed £200,000 to a lender. But the target company also had £50,000 more than the target cash that we were expecting the company to have. So the following are the adjustments that we make to the purchase price. We take £1 million, we reduce it by £200,000, the liabilities, and we increase it by £50,000, which leaves us with £850,000. So effectively, the purchase price is decreased by £150,000. The way that this would then work in practice is that the buyer, instead of being recognized as owing £400,000 to the seller, now owes £150,000 less and therefore only owes £250,000 to the seller. Fantastic. Now, if you've got any questions or any feedback, make sure to put in the comments below, or make sure to answer any comments that you make. Again, if you want to learn more about the share purchase agreement and especially the 2 other ways to adjust the purchase price, make sure to watch this video right here. Thank you for watching.